Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good Monday morning. Let's get to your top stories today. We're looking at market reaction on the back of events on the weekend. Iron ore, for one, slipping alongside the Aussie dollar after the weekend finance minister briefing, leaving investors, well, wanting more when it does come to fiscal stimulus. Now, you have fresh data showing that Chinese deflation is becoming more entrenched, adding to worries over the economy. Trade numbers are also due out later today. That may also show export growth is continuing to slow. Plus, Taiwan's government tells Bloomberg TSMC is planning more European factories with a focus on AI. We hear exclusively from the tech minister, Chang.
You've had 2 days to really digest the news from that Ministry of Finance briefing that happened on Saturday there. Interesting enough, it's a bit of a mixed bag in what we got there, right? So we didn't get that magic number in terms of the size of fresh stimulus. There is some talk about helping local governments. There is some talk about shoring up the property market. Is that enough? Right now, initially, before this market opened in China, obviously there is a slight bit of disappointment. Take a look at things like the Aussie dollar. Iron ore is kind of sort of consolidating, but we did initially see a bit of a drop there at the open. And as well as copper markets. Brent and crude also seeing some downside here. So commodity side of things, you're seeing a little bit of a letdown here post-briefing. Keep in mind, Japan markets are shut here this morning as well. So you're not getting that much in terms of volumes, but we're watching very close to that reopen in Hong Kong after that 3-day holiday as well. You take a look at how the approach to the open is looking like here today. We'll see how this all fares, because it wasn't just what we got from the briefing, but also inflation numbers that we got over the weekend were a bit disappointing as well. PPI falling for 24 straight months. You have core CPI basically near zero. But then again, you have the likes of Goldman Sachs saying, look, I liked what I saw in this Ministry of Finance briefing enough to actually upgrade my forecast, right, to 4.9% for 2024 from Hui Shan and her team. Futures, though, are going all over the place, but we're still punching some decent gains here this morning at the open, it looks like. You are seeing some weakness here, not just in the Aussie, but the proxies like renminbi. The offshore rate is weakening by about 1/5 of 1% here. CGBs, you are seeing a flight to maybe more on the long end, where the 10-year is down about 1 basis point, the 5-year a little bit more buying on that side of things. But certainly there is going to be a lot of questions on what we need to wait. Is it just patience, David, or is this it? This is what we're going to deal with? But we still have to deal with some more meetings in the next few weeks, and also one more briefing this morning as well.
Yeah, in 60 minutes from now, we'll get you a preview of that in a moment. And, was it, to your point, Yvonne, that's important nuance to hit at this point in time. Is it merely because of the sequence of events that you had a Ministry of Finance that could announce something, that there could have been something that they should have said,
yes,
but we're not allowed to because you do have, you have to go through the sort of admin protocol as well. Markets are judging this, well, in two ways, right? For one, there's a reopening in Hong Kong, which I think you have to keep in mind that Hong Kong did close very strong on Thursday. You had a decline in equity markets on Friday, and then we're going into today playing some catch down. But then again, you look at commodity markets onshore right now, you are getting a bid across a lot of the cyclical related commodities like iron ore, rebar futures, copper, as Yvonne is pointing out as well. On top of all of that, we do have we have a CGB sale today, 2 and 5 years as well. And might that indicate, if we do have a lot more fiscal space to bump up the budget deficit target, a lot more in terms of incremental special sovereign and local government bonds, what does it mean with the supply outlook moving forward? Sectors to watch, banks, property, among many, many others. Plus, in terms of data coming through, inflation yesterday, credit numbers possibly today. Trade data definitely comes out later today as well.
Yeah, I think the CSI 300 slid some 3% last week. That's the worst sort of session that we saw for a week in about 3 months or so. So certainly we're watching if there's any sort of rebound here today on the back of what we've heard. Looks like futures are suggesting that here this morning. And let's do a bit of a recap, right? It's been 2 days. Here's what more from Leung, the finance minister, and what he said over the weekend.
We
have expanded the large scale of fiscal expenditure, setting a government deficit of 4.06 trillion yuan for 2024. We have issued 1 trillion yuan of ultra-long special treasury bonds, while making good use of the traditional government bonds issued in 2023. We will increase support for local governments to address debt risk, increase debt quotas on large scale, and support local governments to resolve hidden debts. Therefore, local governments can free up more energy and financial resources to promote development and promote people's livelihood. The central government still has a large room for increasing debts and deficits. We will urge local governments to make the best of funds raised from various kinds of bonds to speed up projects and pay it out in a timely manner according to actual needs to generate tangible outcomes as soon as possible and boost investment.
Yep, to sum up there, basically, it may have lacked the firepower that equity investors were looking for. They talked about more support for the property sector, for local governments, but it may not be enough to even change this whole deflationary spiral that we've been seeing in the economy as well. Let's get to Min Lo, our China correspondent. She joins us here right now. It seems like at least the MOF has a long to-do list now of things laid out by the minister, at least.
Yeah, I think a lot of people were disappointed by the lack of that big magic number. But remember, that's still on the table because any revision to the fiscal deficit, as well as any new bonds above what is budgeted for this year, those have to be approved by the legislature. And the NPC Standing Committee is going to meet likely in late October. So that might be a more appropriate time for us to hear the size of this fiscal stimulus. But the Ministry of Finance did lay out a number of key measures, and among them include a one-off debt swap for local government. And this is key because it would help alleviate some of the pressure for these local governments to repay their debt. It could help them finally expand more resources to actually revive the economy. They're also widening the use of local government special bonds to allow those funds to be used for buying up unsold homes, to be converted to social housing, to buy back idle land as well. And I think it's Ding Shuang from Standard Chartered who said that even without additional new bonds, this widening of the usage of existing bonds, he said, could unleash huge amounts of idle funds that have been left unspent because of a lack of suitable projects, because infrastructure investment, remember, has been very saturated over the past few years. It's seeing diminishing returns there. The other key thing is that the government will be issuing special sovereign bond to recapitalize the big banks to, again, ease off the profit margins after the PBOC called for cutting mortgage rates and slashing key policy rates as well. But I think the big disappointment here is the fact that all of these measures, none of them really targeted boosting consumption in a big way. There was cash handouts in terms of doubling the number of quota for scholarships for college graduates, but nothing of the scale that investors were looking for, and that is the big disappointment here.
What commentary have you seen so far around this? Give us more color and sort of reaction from analysts here.
Yeah, so I mean, you have Goldman Sachs saying that this is largely in line with expectations, and they're raising the growth forecast from 4.7% to 4.9%. There are also analysts who are saying, yes, there's going to be disappointment, and if markets sell off 5-10%, they're going to see this as a prime opportunity to buy, because the whole policy backdrop is quite different from where we were a few months ago, where China was just seen as uninvestable. But of course, we have the CPI data coming out that came out over the weekend. Very disappointing there. Core inflation, I mean, Consumer price index was 0.4%, missing expectations, but you had vegetable food prices increasing because of the typhoons, the bad weather. So if you strip all of that out, the food prices and energy prices, and look at core inflation, that's hovering above zero. That's the weakest we have seen since February of 2021. And so that fiscal stimulus is extremely important. And I think the forward guidance is key. The ministry said there's still relatively large room to raise fiscal deficit. Perhaps that's the most they can say at this point without, approval from the legislature, but I think that is also something that could help shore up a bit of confidence from equity investors.
Min, thank you so much. Min Lo, been busy throughout the weekend here, our China correspondent. Let's take you straight to Beijing and bring in our first guest this hour, David Daokui Li, Tsinghua University Director and former PBOC advisor. Good morning, Li Daokui. Thank you for joining us on the show here. Well, what's your initial assessment of what was said on the weekend from the finance ministry?
Well, I think in terms of direction of policy adjustment, the Minister of Finance was absolutely right. That is, the central government needs to rapidly and in a major way increase its debt issuance, and as a result, to support local governments. In terms of direction, he was very, very on spot. However, he was not upfront in terms of the amount of the new issuance of central government debt For that, he needs the NPC, National People's Congress, to support him. However, the good news is in China, we don't have a good or a bad. We don't have a two-party battle in the NPC. Once the central government decides what to do, the NPC will follow up quickly. So I do expect that by the end of this month, there will be a huge increase in the central government debt. And using that, the central government will support the local governments. Local governments getting the cash will pay their delayed payments to their employees, to their contractor workers, and then the macroeconomy, the real sector, will be back on track.
So you said there might be room for further stimulus, Daokui. I'm just wondering, are you saying that it's likely then that they're going to repeat what they did last year and basically raising that fiscal deficit target of more than 3%, or do you think it's a little bit too late in the year to do so now? Does it matter actually now if they do it?
Well, okay. Well, for this year, the 5% GDP growth rate is not a big issue because technically this target will be achieved because the 5.0 is real GDP growth. And real GDP growth is actually nominal GDP growth divided by GDP deflator. And deflator is a mystery. Nobody knows actually how high it is, how low it is. So 5.0 technically is not a big issue. There will be in the end that it will be achieved. Okay. However, the real issue is how to make sure the economy will continue growing next year and the year after. And the economy, how can the economy recover from this carbon problem? The carbon problem has major problem in one thing, that is local governments are running out of cash. Local governments have been using short-term debt and loans to finance 20-year, 30-year long-term infrastructure projects. So it is irrational, it is even crazy or draconian for local governments to pay back their debt in the coming 1 or 2 years. This is a self-inflicted wound, okay? So finally, the central government got it right. The central government needs to issue tremendous amount of bonds to swap out local government debt. This is more than deficit. This is a capital account management. That is, central government has assets and liabilities. They have to manage this capital account. By the way, the Chinese central government is by far the richest central government in the world, holding shares of the most profitable commercial banks and the 3 most profitable mobile phone operators. There's no reason for the central government not to issue a huge amount of debt to help out local governments and in turn to help out macroeconomy.
Yeah, Professor Li, that's a very good point because I think a lot of foreign investors get stuck on wanting a big number where a big fiscal number could mean an increase in central government budget deficit. There's also the matter of an expanded budget deficit, which includes special purpose bonds, local governments, plus, of course, this transfer that you talked about there. So take us into where you think the overall budget deficit should be. So all things included, central government budget deficit, local government spending, how big should that fiscal hole be next year and the year after to get China's economy out of this deflationary spiral?
Well, to give you a very quick answer, I truly believe a 3% deficit, at most 5%, will be more than enough. But my key point is that this is a wrong question. This is a wrong question. We are thinking in a conventional way. We are thinking about the current income and current expenditure of the central government, and that we call the gap is deficit or surplus. What we are needing, what the central government needs to do, is to manage the asset part, the asset liability account of the central government. The central government of China holds lots of assets in stock market listed companies, such as the 6 most profitable commercial banks. Meanwhile, the central government holds very little, only 25% at most of GDP in terms of debt. So there's a tremendous amount of net equity for the central government. What central government should do is to issue more liability, issue more debt, and use the money to buy local government assets in the form of infrastructure projects. So this is a capital account management. This is for in a sense of in the company in the paraphrasing the company's language. This is a merger and acquisition (M&A) operation. This is not spending your capital expenditure. This is not about the current account. This is about asset management. So I truly believe we economists have to really restudy public finance. We need to have a new mentality, a new framework to explain this to the policymakers and to the business people, to the general public.
Daokui, hold on, I thought we'll have more from David Daokui Li there, Tsinghua University Director and former PBOC advisor. Still ahead, JPMorgan joins us to talk about their strategy when it comes to stocks as revisions show Chinese earnings now recovering to two-year highs. Wendy and Leung joining us at the bottom of this hour. We're also counting down the opens of trade in Shanghai and Shenzhen and the reopen here in Hong Kong. Futures are rising this morning. This is the China Show. All right, China futures are punching about close to 2% here this morning. So we continue to see stock futures rise as we digest of what happened in the Ministry of Finance briefing here. Initially, we're seeing a bit of disappointment. Looks like stocks, though, could have a pretty decent day. We are also, though, seeing CGBs. That rally is actually continuing today as well, and a bit of weakness in the currency. Still with us in Beijing is David Daokui Li, Tsinghua University Director and former PBOC advisor. And David, I want to pick up on something that you mentioned in the previous segment about the direction of travel. It seems like the direction of policy is finally heading more positively. It may be more important than the size of what we get. Why do you think we are seeing this sort of shift from the PBOC, the NDRC, and the MOF? What's prompting this shift, do you think?
Well, fundamentally, it's the reality of the macroeconomy. The reality of the macroeconomy is super simple. That is, everybody knows that the local governments, who are the biggest problem, the source of problem of the macroeconomy. The local governments, to be frank, they normally spend 41% of GDP, okay, including their regular expenditure as well as their infrastructure investments. 41%. Remind you, households only spend 38% of the GDP, okay, consumption, right? So when local governments are shrinking from 41% of GDP in terms of their expenditure to today something about 36%, 5% decrease, no wonder the economy will shrink. The economy will contract. Okay, so finally, the policymakers got the point. Okay, until now they were pushing local governments to pay back their short-term debt, to squeeze to tighten their belt to do that. This is crazy. This is suicidal. This is a self-inflicted loan. So owned. So I have been arguing against the previous policy in China for 2-3 years. So finally, as we say in China, the reality is more powerful than any scholar's arguments. The reality is sitting in, and finally our top policy makers are coming to the reality. And the solution is super simple. Super simple, because the central government is really rich in its asset. I'm talking about its net equity position is very high, okay? Holding a lot of profit shares. They can issue debt. So this is the right direction.
And I think that settles the question whether there is money to be spent. The other question is where that money you think should be best spent. And, getting to a 5% growth target, you spend projects, you get to 5%. The other question right now is, do you think the set of measures, the money that's available, and where they signal that they will be spending that, will that address the crisis of confidence among consumers?
Right now, yes. I'm going to give you a simple answer. Because local governments have delayed or postponed a lot of payments. How much money they have postponed, paying their contractors, paying some of their employees, direct employees or indirect employees. 1% of GDP, easily 1% of no, wait, I'm sorry. 10% of GDP. 10%. I myself often get surprised by the huge amount. I'm talking about 10% of GDP is now in delayed payment to various companies and employees. No wonder consumers are not forthcoming in spending money because they are not getting paid. So that's number one source of expenditure, okay? Don't let local governments to do infrastructure. Enough infrastructure, I mean, qualitatively speaking. However, pay your whoever have worked for you, okay, including those people who worked hard for them during the pandemic years, okay? Pay them, give them cash, not only honoring their contract in the spirit of honoring good contracts, okay, foundation of market economy, but also for short-term economic stimulus. In other words, the biggest economic stimulus is for the local governments to pay back their delayed payments to companies and their employees. That's it. This one thing, 10% of GDP, is there. Super simple.
David Daokui Li, thank you so much for the time this Monday morning. Message across, message clear there from the Tsinghua University Director and former advisor to the PBOC. Going into the reopen today in Hong Kong, we're down a little bit on the Hang Seng Index in the pre-market. We're called higher, though, across A50 futures, 1.2%. The opening bell this Monday, under 7 minutes away. You're watching the China Show. Right, welcome back. Happy Monday morning. Initial market reaction. I think you have to, take into consideration Hong Kong markets were shut on Friday, so there was an element of catch down. We're down 1/10 of 1%, although when you're looking at futures, A50 futures and the contract here in Hong Kong, we're pushing about 1.5% higher this Monday, perhaps in reaction to what was said over the weekend.
Yep, and in terms of sectors to watch, obviously the property sector is certainly one thing, given the, you see more of a forceful language around trying to at least reverse the downward spiral that we're seeing when it comes to home prices and the like here. So they're promising new measures to support the property sector. That certainly is lifting most of these developers here today. China Wonka is up some 5%. And the banks as well. There was talk about recapitalizing the banks, although there wasn't a clear number there. But certainly there is some more signs of support for these lenders as well. So certainly one to watch here, of course, is that reopen. And what we're seeing in Hong Kong, 1.5% or higher when it comes to A50 futures here this morning. There you go. The banks are also rallying here, using special CGB issuance to support these major state banks as well. The open is next. This is Bloomberg. All right, we're just moments away from that open in China, that reopen in Hong Kong, really seeing what the verdict is from this Ministry of Finance briefing. Did they deliver? Did the Ministry of Finance actually get a pass on what was heard? We just heard from David Daokui Li saying, look, the direction of stimulus, that's perhaps more important. And perhaps this is what the most that these policymakers could actually say ahead of that MPC Standing Committee meeting just a few weeks away. So is there more room for further stimulus? Is there more room for this rally to continue? Certainly is a big question here today.
Yeah, well, I think you're right. If you put those two latter things together, that if you need further fiscal stimulus or more for a market rally, then we probably won't get a rally. What we did get, though, was a more efficient use of the money that's already there and the bonds already issued. Now, not to say that further fiscal expansion is not on the table, right? To your point that you need the State Council to come out with that as well. CSI 300 up 0.8 of 1%. It's been a roller coaster to say the least. It's Monday morning. It doesn't feel like a Monday, really. It's just a continuation of really the manic trading we've gotten from late last week, press briefing on Saturday, CPI numbers on Sunday, the reopen in Hong Kong today. And in 30 minutes' time, we have another briefing to tell you about, which we'll show you in a moment. Hong Kong, the reopen should be lower based on what we last checked. Just keep in mind we closed stronger on Thursday. And then you had that drop, of course, on Friday in the onshore market. We're down about 2% on the Hang Seng Tech Index. A glance at some of the big stocks, bottom of your screen. So we're looking at the banks and the and property. We'll more on that in a moment. CGBs. So on top of possibly more room to increase the fiscal or the budget deficits, You are also going to get a 2- and a 5-year bond auction today. Keep that in mind. Bonds across your screens are down just about across the curve from the 2s all the way to the 30. Property should be on the way up. More use from the local bonds, local government bonds in terms of buying unused apartments and inventory. Up almost across the board, at least on your screens, and the state banks, of course, on the back of potentially more fundraising and increasing their capital. Not that they don't have enough capital already, but I think you look at what's been said so far and what that might mean for their Tier 1 capital, which I think is at 13%. But it's quite substantial already.
Yeah, let's bring in our Chief North Asia correspondent, Stephen Engel, who joins us now. Steve, it seems like onshore markets are actually somewhat satisfied with what we heard over the weekend.
Sure, and I think there was efforts to kind of stabilize sentiment. You guys are both parents, right? When you feed your child too much sugar, there's a crash, right? So perhaps they're holding back on all that glucose, so there is not necessarily a crash and estimates of further stimulus. Is there room for further stimulus? Well, all indications from authorities that we've heard from is yes, but was there a specific number? And I think that's what kind of disappointed following Saturday's finance ministry briefing. There were a lot of expectations. That was from Shen Meng at Beijing-based Chen Sung and Company saying basically they tried their best, but there's a huge gap, they say, between what the market was expecting and what they delivered. They did not give that number, and that number that was bantied about was about 2 trillion yuan. That is expected to come in the form of fiscal stimulus. That's $283 billion US. It didn't come. A specific number did not come. And there, I know you've probably read all this, there's speculation that maybe there was a junior official on the podium there on the dais saying, shall we release the number or not? And they didn't. So that's added a lot of intrigue. I don't want to go too far down that road. However, I know how Beijing operates. They will release a number when they feel it is most advantageous to do so. So the fact that there is a potential 2 trillion, I don't know if that's the actual number, that was just speculated, that is potential down the road. So again, the market is on tenterhooks for the open right now. So.
Well, the direction is clear, at least. What else are we tracking moving forward?
There's going to be another briefing within this next half hour by the State Council Information Office. And interesting, look at the people who are going to be attending. It's going to be the Director of the State Administration for Market Regulation, so a market regulator. Also the Vice Minister of the Ministry of Industry and Information Technology, the Vice Minister of Justice, as well as the Deputy Director of State Financial Supervision and Administration Bureau. Now, this could be many things. This could be a further emphasis on market discipline. We all know that the authorities led by Xi Jinping has tried to crack down on kind of a hedonistic lifestyle in the financial sector. They want to damp down reckless speculation in the market. On the other hand, they also want to promote private enterprise law and as well instill confidence in private enterprises. So if you look at this mix of regulators and officials, you can see, yes, there's going to be probably some, remember, there needs to be some discipline, but at the same time, we're going to promote private enterprises.
Let me come out with a pun there. Is this rally justified? Minister of Justice coming out. Anyway, it's Monday. Bear with us.
Is that a rhetorical question? Or is...
Well, let's put that question to our next guest, shall we? Stephen Engel, our Chief North Asia correspondent there. I mean, when you look at how quickly this market has gone up, right, a lot of the people that we've talked to the last week or so have said the easy money's been made after this near vertical run up. In fact, momentum has rarely been and touched these levels. On your screens, MSCI China, RSI, 14-day, 90 twice in the last decade. One of those times came in the last few days or so. So what now? Wendy Liu, Chief Asia and China Equity Strategist at JPMorgan, joins us right now. What now?
I think there's going to be consolidation and pullback, which after looking at the RSI earlier last week, that was our conclusion. And I think with the stimulus as it's been portrayed, the positioning on the client side, maybe there's too much consumption, a little less on the financial and real estate complex. And I think to have a swap of the local government debt that will ease the accounts receivable pressure in that whole ecosystem, which has been worsening based on the financial data. So I think structurally it looks fine. Short term, it is not as satisfying. And I think the structural stimulus will be sort of positive to the long-only investors looking at the investment on a 2 to 3 year view. And this is the time that they can take time to pick the alpha because, like you said, the big beta trade has happened.
And I mean, just given, as you mentioned, this extreme sort of overbought conditions we're seeing across these markets, I think HSCI is up 30% in the last 3 weeks. You got the CSI 300 is up 20% still since that announcement back in September. How big of a pullback are you sort of foreseeing now?
Yeah. So we did some analysis on event triggering duration. Like since 2022, event triggering catalysts, the maximum impact on the upside is happening between 12 to 20 days. And then on RSI reaching at these kind of level, if it's happening at the beginning of the bull market, it consolidates for a couple months, depending on the event-driven catalyst, and then it can go up, which was 2014. But it happens at a very late stage, like 2015, then it depends when the regulators come in to put in more constraints, and it could roll over. So we are hopeful that this is the 2014 repeat, and it just needs to have a little bit of a curbing on the enthusiasm. When we look at the flows, offshore ETF, for China-related ETF, before Golden Week, the inflow was $2 billion a day USD. After, $1 billion. Onshore, the opposite. It was $2 billion a day before, $8 billion a day after.
Are we, based on your data, are we back to neutral as far as positioning is concerned? Like how far does that dial have to move even further at this point in time for global investors?
Yeah, that's a question that people ask. I think it's not at neutral. Every 25 bips underweight being narrowed, that's about 40 billion inflow USD.
Okay. Wow.
And 25 bips is across 4 types of funds: AEJ, EM, global ex-US. But I think the difficulty people have is that how much do we pay on the multiple? It's slightly below historical average, and the hope is that with the stimulus, 2025's EPS could get revised up. Now, mind you, from 21 to 23, China equities have been at a disadvantage because EPS was not strong, and Japan and then India was great. And this year and next year, based on consensus, if you take out 2 very cyclical markets, Korea and Taiwan, China's in line with the rest of the APAC markets and slightly better than some other markets. So I think it's about how much earnings upside and how long this cycle can sustain. And the bull case from my smart investors is that you can get into a nominal growth situation, market share gaining, and then margins expansion, which is the success recipe for India, then China equities has long way to go. But it'll take a few quarters to see if that can go in that direction.
We're showing a chart, Wendy, now on earnings revisions and how analysts are actually seeing profits are actually rising now. In terms of what you're foreseeing, what are you recommending in terms of where we could see the most upside for results?
Yeah, so I think communication services, gaming, entertainment has surprised on the upside. Discretionary have definitely surprised on the upside. So these are the internet companies, very, very good investor return mindset. The laggards are in IT, property, and industrials, and so it would be good to see broader sectors participating on the upside. So this fiscal stimulus, the vision of capping the banks a little bit better, and then setting a floor to property prices, not boosting it, but setting a floor, and then allowing the credit to flow again by removing this inability to pay by the local government should be good for the laggards. Yeah,
in a couple of weeks we'll be moving into earnings season. Is it too early or premature to expect the optimism show up in forward guidance from corporates, particularly in the sectors that you mentioned?
It's probably too early. 3Q, I think, if you look at CPI, PPI, there was deflationary pressure, and the high-frequency data is meandering sideways. If we look at our quantitative macro indicator from July to August, it actually pulled back, and that probably explains why the financial authorities became so assertive. Okay, so I think people will be forward-looking to 2025. At the same time, I think for more EM investors, they need to see the outcome of the U.S. election and the Fed decision, and what does that mean for the DXY, which is hugely important to the FX and the EM risk asset.
You've been looking at also that capital reform guidelines that we've seen. It's interesting, right? You compare it to 2004, 2014, and you're saying once basically the hopes of all this fiscal stimulus, that once we get the dust settled with this magic number, there's going to be more hope around stabilization funds and the like. How do you compare it to what we've seen in the past?
So China has had 3 rounds of market reform guidelines. So 1.0, that was 2004. Right? And then 2.0 was 14. And then 10 years later, we're now at 24. So the upside in CSI 300 in 1.0 was 359%. Then it went down to 151%. So we're probably at 20-25% upside. And you would hope there's institutional building based on best practices around the region, the type of national stabilization fund. We saw that in other markets, like in Japan, and then an SIP, systematic investment plan, in India. So we're hopeful because the national team, the operation of it, we can find some traces from the ETF flows. And recently, we could see the re-lending facility, if that kicks in, and the swap facility will give us some sense. But it would just be more transparent and process-driven if we see the stabilization fund and funds or institutions like SIP. Yeah.
How does this affect broader Asia strategy? You look at the region as well. I mean, has this resurgence in China in some way affected where you think the big winners will be next year? Big winners so far: India, Taiwan, Korea.
I looked at Asia strategy with 2 other colleagues, Rajiv Batra and then Mixo. I think at this point, the incomings are very much about where do I move some of the flows from elsewhere in the region into China. If we look at last week's flow, EM has a huge inflow, right? Highest since October 2000, based on our data. And the predominant recipient was China. And our EPFR data shows that except for Taiwan, had a modest inflow, it was primarily China. So I think people recognize this is an inexpensive asset and has potential for earnings upside. Yeah.
Wendy, great to have you. Wendy Liu there, Chief Asia and China Equity Strategist at JPMorgan. To digest all the news that we got over the weekend, it seems like mainland equities as well continue to gather strength here on the back of what we've been hearing over the weekend. So may not be just that disappointment that we saw earlier when it comes to commodities. You are actually seeing equities catching a bid here today. You can also turn to your Bloomberg for more on this. T-Live Go to get plenty of commentary analysis from our expert editors. That is all happening this morning. Plenty more ahead. This is Bloomberg.
Right, a market update 16 minutes into the new week, really. So CSI 300 is catching a bid. Of course, Hong Kong is reopening after being shut on Friday, so we're flat. Right now, we opened lower, which is a good thing. HSTech is still slightly underwater. I'm being extremely generous with that description there. The big winners so far have been the developer stocks, maybe on the back of more tangible and targeted measures coming out of the briefing that we heard, of course, on the weekend.
Yep. So certainly there is a positive in terms of sentiment here this morning when it comes to stocks. HS Tech, though, that one seems to be still the laggard here this morning. That catch down, as Dave mentioned. But we're going to focus a little bit on geopolitics now, where China's military is holding drills around Taiwan that it says are warning to the self-ruled island's government to halt what it calls separatist acts. Now, a spokesman says the exercises involve Army, Navy, Air, and Rocket forces. Taiwan's defense ministry says that it dispatch forces to respond. Taiwan's President Lai Ching-te said last week that he would stand up to the challenges posed by China.
Now, Washington's support for Taiwan amid China's growing assertiveness is one of the diplomatic flashpoints that the next U.S. president will have to, well, effectively confront. We spoke to Taiwan's National Science and Technology Council Minister Wu Chang-wen about how the U.S. election may impact the island's chip production.
I don't worry about whether the Republic or the Democratic parties. That I believe they will all agree on continuing the same direction. I don't worry too much about that.
Do you see that putting further pressure then on Taiwanese companies to expand production facilities in the US?
Well, it's an issue. I believe, yes. But in short term, maybe it's painful for the Taiwanese companies because it's more expensive, actually, if they move over there. But in the long run, maybe it's good for them, from my point of view, because they can improve themselves.
I do want to talk about the other areas for cooperation between the US and Taiwan, and drones has been highlighted as a particular area.
Drones, yes.
Where would you look to partner?
We are working on a model that maybe we can establish a local supply chain here in Taiwan, from chips to other components and to the modules to system. And we would like to work with the US based on the innovative systems that have been developed in the US, because in the past we don't have this kind of industry.
China has really established a lead in the drone market for a variety of different uses.
Right, we know that.
How long is it going to take for Taiwan to catch up, and can it catch up, do you think?
That is why we are working on this project now. We don't want to use drones from China anymore in the future. Our intention is to gradually replace all the components from China. And as a matter of fact, most of the components may be made by Taiwanese companies in China today, but in the future, we would like to invite them to come home.
Returning to semiconductors for a moment, but speaking about China, people will talk about the technological advancements that China is making in its chip technology. Others would say, actually, you need to think about how far is China behind TSMC, and that really gives you the true indication.
When we talk about the most advanced technology, I think China is behind quite a lot. But if we're talking about mature technologies, they are not behind.
How many years then are we talking about?
When we talk about the most advanced manufacturing technologies, which is 2-nanometer silicon technology, CMOS technology, I openly say that more than 10 years.
You mean it takes a full decade to catch up, or you think that it can be done sooner?
Not any sooner. Impossible.
Taiwan's National Science and Technology Council Minister Wu Chang-wen there with our tech reporter Annabelle Jewelers. Now, if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function TV Go. Join the conversation. You can send us instant messages, questions for our team and our guests during our live shows. Check it out at TV Go. This is Bloomberg.
Welcome back. You're watching The China Show. Some big moves across the brokerage space. These are A shares or shares onshore that you're looking at on your screen. So limit up for, this is the big merger, of course, Guotai Junan and Haitong Sec. Separately, the story, and we're limit down on CICC, being probed and investigated here by the securities regulator over a specific IPO, bottom of your screens, S2C. So watch for that. Any developments out of that more closely. We're looking at casinos as well. Change the page, please. Macau electing a former judge that had voiced some recent concerns over at least the over-reliance of one industry. That's, of course, casinos, and it pertains to Macau. And we're looking at, as you can see, declines across the board on these big casino shares here.
Yep, so a little bit of concern there when it comes to the casino sector, but there you go. You're not seeing that much concern when it comes to the CSI 300 here right now. We're up some 1%. We're off some of the initial gains, but certainly the verdict still seems to be like what we heard from the Ministry of Finance was definitely better than what we heard from the NDRC earlier the week before, but not as good as the PBOC a few weeks ago.
They're playing with our feelings.
Right? So at least they still passed, according to equity investors here. You're starting to see that being played through when it comes to commodities as well. Shanghai crude, iron ore doing a little bit better during the session here. CGBs, though, still seeing a bit of a rally there, but Hong Kong not quite participating so far. We got plenty more coming up. That State Council Information Office briefing underway. Welcome back to the China Show. Here's a look at the CSI 300 just a half hour into the session, and we are actually continue to see some, paring back of gains now, but higher volumes when it comes to this market post MOF briefing, where we were short on details when it came to the size of this fiscal stimulus and how much new money could be coming in. Didn't get quite that, but at least the direction of policy seems to be more to shore up the consumer, shore up the property market at least, and as well as helping a little bit those local governments, Dave.
Yeah, I can't remember the last time the State Council Information Office was this busy organizing press briefings.
Presser after presser.
Yeah, PBOC, NDRC, Ministry of Finance, and there's one coming up in a couple of minutes, which will be including the NFRA, the SAMR, and the MIIT, and the Ministry of Justice. So, we'll stay tuned for that and what they could say. In the meantime, though, markets, as Yvonne is pointing out, so you have two things. You have CSI 300 coming off highs a little bit. You have Hong Kong, which is just reopening today. You also have sector dispersion within MSCI China. Should be coming up on your screens very, very shortly. Things like turnover, comparatively speaking, peaked mid last week. We've since come down, but certainly compared to the year-to-date averages are still multiples above your year-to-date daily averages. We're looking at most sector groups down, with the exception of property and financials on your screens. That might be the brokerages. I could be mistaken. But as you can see, things like consumer staples, healthcare, IT, and discretionary are all leading these declines. Speaking of brokers, you have some of the big ones on your screens coming up very soon, as well as some of the big banks as well. Do we get to see more capitalization as far as the banks go? What does it mean for returns? What does it mean for dilution? And, of course, as it pertains to property, the big story, of course, was more, a broader usage of the government bonds beyond traditional uses, going into things like buying unsold inventory, for example. So we're looking at property also leading those gains as well. Asia, outside of China, outside of Japan, which is shut today, have a look at where we are. Broadly speaking, the global bull market has some decent momentum. I think we're up 5 weeks in the last 6. The S&P 500, a good example of that, is up for 5 straight weeks. As far as that's concerned, and we're moving into the thick of earnings season, right? So is the Fed going to cut 50 or 25? If they are cutting and China recovers, does it bode well for, I guess, the outlook for equities over the next couple of quarters?
Yep, but as Wendy Leung from JPMorgan mentioned, right, just given how extreme these moves have been the last few weeks, where we basically haven't seen RSIs above 90, I think you said twice in a decade?
Twice in the last decade.
So we're bound for some sort of pullback, as she mentioned there as well. So cooler heads may start to prevail, is what her message was today. Let's bring in our next roundtable now. Stephanie Leung, Chief Investment Officer at digital investment platform StashAway. Also with us is Bloomberg Economics Chief Asia economist Chang. Chang, I'm going to start start with you. Are you satisfied? Was it sufficient, or are you disappointed by what we heard?
I think the briefing is actually very much in line with our expectations. I think the recent various announcements have been positive in the sense it did or has lifted sentiment, but at the same time it has somewhat generated, not intentionally, but it has generated some unrealistic expectations about stimulus. And some people were expecting massive money coming very, very quickly. And you are right in pointing out potentially, cooler heads are prevailing. We have consistently said there's no more additional money for the rest of the year because the government has been slow in its spending. We still have, close to 20 trillion yuan for the rest of the year. As of the data by August, so it's still quite a lot of money there. That's 45% of total budgeted spending, not yet go out to the right places. So the government is right in focusing on spending that amount. At the same time, the more focus on unclogging the system. Yeah. The important thing, the local government unable to spend and the property market is suddenly causing issues.
And you guys think, I was looking at your briefing note here, that this one-off move to free up fiscal space for local governments, that was the biggest takeaway for you guys. Tell us why.
Yeah. At this point, the local governments are really under constraints. They are just under stress in terms of under heavy debt burden. At the same time, the expenditure, the regulation is quite tight for them to get a new approval for projects.
Stephanie, I'm going to get your take. How did you feel about what we heard? Was it enough? And are you disappointed we didn't get that special number in terms of fresh stimulus?
I guess if you take a step back and think about the things that they need to do to fight the cyclical problems of deflation, not to mention the structural problems, right? It's I think we come in waves, right? And it's the government is taking its time. Now, if you think about the monetary announcements, they've actually waited quite a bit until the Fed started cutting to start announcing these policies. So, they actually have to think about timing as well, and there's no rush to push everything at once. And if we think about the timing right now, you have, of course, the U.S. election that's coming up in a few weeks, and putting yourself in the Chinese government's shoes. There's a lot of uncertainty going on, right? It's still 50-50 whether Trump is going to be in the House or Harris is going to be in the House. So I think there's a bit of that thinking going on as well as to observing what's going on in the U.S. political space before actually coming out with the next round of very, very concrete big-scale stimulus. And I think we have to take that into account.
It's probably fair to say, there's a big group of investors who missed the initial rally in China, waited it out and see how things settled. What's your advice to those people who missed out? Do they get back in? Do they wait for more clarity? Do they wait for a dip? Or is this all in at this point? Yeah,
it's been a phenomenal rally, right? We've seen a 30% plus rally, and for property sector over 100% plus in a very, very short time. Now, we dissect what's been happening. A lot of that was actually short covering. There's a bit of rotation for long funds into the more economically sensitive sectors. So that's what's been going on. I think as far as we understand, when we look at the data in terms of long-term position investors, a lot of them are still underweight. And there's still a lot of money on the sideline looking at how Chinese policies will pan out and how economic data will pan out as well. So for us, we've been market weight since April, but we're also waiting for the more details about fiscal, because I think that would really signal whether or not we can get more positive on earnings for next year. And I think that's the key to longer-term investors.
And Chang, maybe you can chime in on just what else is still needed. You look at the inflation numbers that we got over the weekend, and we're still very much seeing that deflation is very entrenched, in fact, even more in September. Have we heard enough to at least see a change in how inflationary pressures are going to go?
At this point, we heard enough in terms of the direction, and clearly going forward, we really need to see more specific measures, headline figures, and specific how and where the government is going to put the money. We know the government will have to continue to do the usual, the thing China is good at, big projects, etc. But at the same time, we do see the need for the government to support demand, both in terms of consumption and investment. And again, the signals are there, but we don't have sufficient information yet to gauge to what extent the focus is starting to shift. So that's on the sort of spending side, but there will have to be the housing side, we just talked about the government is thinking about stabilizing the market, property market, but for us it's more about stabilizing transaction, unlike some investors expected to get the price to jump. That's not quite. We don't believe that's what the government is intending, and then importantly the local government side.
Yeah, Stephanie, I'll bring you in because stock market policy seems to be now part of a broader mix of economic policy, right? We need to stabilize the equity market. We've seen measures that target the equity market. As things pull back, and things are pulling back right now, I'm looking at my screens, do you think they've established at least a higher floor in the equity market?
I think if you think about the first step of the stimulus, the monetary side definitely, I think, has backstopped in terms of the kind of the downside. I mean, it's clearly that there's the Fed put that we've been talking about, but now there's also a Chinese policy put. And I think if you look at the kind of the tools that Chinese government can still deploy, there's still quite a number of tools that they haven't pulled out. So I think from that side, obviously the downside is much more protected right now. Now, we've had I guess if you look at the equity market right now, price to earnings ratio have rebounded back to sort of historical average. So from here onwards, I mean, the upside really depends on the earnings outlook for not just this year, but also next year. So far, I think we've seen some recovery in terms of Chinese earnings, but still, if you look at the kind of 3 to 4 year trend, it's been down. And to change that kind of entrenched trend, I think we need to see much more fiscal. And the fiscal detail is actually quite important because so far, I think in the past few years, we've seen a lot of stimulus. But I guess investors have been conditioned to fade these stimulus because a lot of them are actually supply driven. And it doesn't resolve the problem of consumer confidence. So that's why I think this time around, if we can see kind of much more direct stimulus on the demand side, on the consumption side, that would send a very, very forceful signal. And I think that's what we're looking out for.
Seems like investors are quick to chase the consumption side in this market.
Yes.
Would you continue to chase?
Yeah, I think if you look at some of the Chinese consumer names, they're not too expensive and they're at a discount to global peers. So I think for those companies, it's actually worth paying a lot more attention.
Chang, I'll bring you back in. What starts to improve in the economy? Like, what are the first indicators that might be the first to respond to everything we've heard so far? I mean, we heard from Goldman Sachs, they bumped up their growth forecast. I'm not sure if you guys are ready to do that as well. But just map out the indicators to watch moving forward here.
Yeah. So I would really focus on what the local governments are doing. I keep coming back to the same theme. The local governments are really tied up at this point, unable to do much. I mean, back in 2015-16, the economy was not doing great. The local governments were not getting enough expenditure yet. Enough revenue yet. They continue to spend, but this time it's different. It's sort of that they are really not doing as much. So that's the key indicator we're looking at. In terms of the growth outlook, maybe I should just quickly address that as well. We have not kind of bump up the forecast for this year. We maintain our forecast at 4.7%, but we do see quite clear upsides for that forecast. But 2025, we see potentially growth will increase our projection. But at this point, without actual figures, we can possibly only do kind of a scenario analysis if this happens, if this is amount, what it can be.
Right, team. Chang, thank you so much. From Bloomberg Economics, there's Stephanie Leung will be staying with us for the next couple of minutes here. Lots more to talk about there as far as markets go. Still ahead here on the China Show, here why Bloomberg Intelligence thinks that the fiscal stimuli, singular, and what it means for the embattled property sector. Analysis on that specific area coming up from Christy Hung. This is Bloomberg. Good Monday morning. That's the silver lining. The greeting just now. Everything on the floor on the HS Tech Index. We're down 170 points. It's about 3.5%. All 30 stocks are down as things reopen, of course, here in Hong Kong. Still with us here on set, Stephanie Leung, Chief Investment Officer at StashAway. I think we've talked already at length about China. Just give us a broader take for risk assets as we look at the next 6 to 12 months.
Sure. I think perhaps we've all been conditioned to kind of straight line up by the AI stocks, NVIDIA, etc. But I guess if you look at kind of the market today, I think it's a much more gradual kind of up climb from here. We've looked at the economic regime, and we've actually switched from a kind of stagflation regime into an inflationary growth regime in April. And I mean, so far we've seen that playing out in the sense that, I mean, the Fed has actually kind of started cutting, but I mean, inflation is also coming down on a much more gradual pace. I think if you look at kind of the Fed action, 50 basis points of cuts, that's actually never happened before in such a market environment. The last two times when the Fed cut 50 basis points was in 2001 and 2007. Now, we all knew kind of what happened back then. Today, we have a market that's up 30% plus in the past 12 months, and the Fed still cut 50 basis points. So I think what that is kind of telling us is a very, very clear signal that the Fed is kind of now wants to get kind of ahead of the curve instead of being sort of viewed as the market as behind the curve. And that's actually very conducive to growth. Now, of course, inflation has not come down as quickly as we hope. So there's this kind of, I think, dilemma of, growth is still good, but then from time to time you still need to kind of worry about inflation. And that's why, I mean, even though the market tends to be higher in this kind of regime, it's not a kind of, I guess, a smooth sail as before. But I mean, use these pullbacks as we tell our investors to accumulate more, because I think the bull market is much more sustainable.
Yeah, and you add that to the China stimulus. I'm just wondering, the Fed's easing cycle begins. You got China also cutting rates and maybe unleashing some more fiscal stimulus. Does that, to you, confirm more of a no landing scenario then?
Yeah, I think what's interesting is that for the past kind of, I guess, 2 years or so, global investors can just forget about China. Right, we operate on like the U.S. clock. I mean, you may be thinking about kind of India and Japan sometimes, but you can largely ignore China. Now, with this kind of like stimulus and this round of policies, you can't ignore China anymore. We're back to business 24 hours a day. And I think that what that means is that, I mean, what's happening in China, if they kind of succeed at stimulating the economy, is that that's going to create more demand globally. And I mean, from a China perspective, they've been exporting deflation. I mean, they've been fighting deflation, and that has kind of helped the inflation picture in the U.S. as well. Now, if you think about China also going back to an inflationary environment, I mean, that's actually sort of, I guess, on one hand, good news for growth, but also on the other side, creates more problem for the Fed down the road for kind of cutting rates very aggressively.
Yeah, I was going to ask you, is that an inflation problem waiting to happen?
Yeah, so I think now it's still too early. I mean, we've got kind of still, if you look at like the manufacturing PMI is still below 50. So, I mean, things are still rather weak from a cyclical perspective. However, if we look kind of forward to 2025, we think that, I mean, that part of the economy is going to start to recover. And that could actually prompt good inflation to kind of go up higher. I think you've got a bit of taste of that from oil. Obviously, oil prices have spiked recently due to kind of geopolitical conflicts in the Middle East. But part of that is also Chinese stimulus as well, right? So I think if this kind of goes on in the next few months, I wouldn't be surprised that, I mean, you would see kind of goods inflation picking up. And if you look at the latest inflation number from the U.S., I mean, services inflation is still quite sticky, right? You've still got that part to work through. So as we look forward, I think there's a bit of an interesting tangle between U.S. and Chinese policies. Of course, I mentioned that China has been very, very patient to wait for the Fed cut to start the easing cycle. But also, I mean, the Fed would be looking at data, right? It would be looking at inflation data as well. So the more China eases, I mean, perhaps, I mean, the more difficult it is for inflation to come off. And I mean, that gives less room for the Fed to cut. So again, this is kind of, I think there's a balance between the two.
So what's the implication for risky assets, as Dave mentioned, or even asset classes that you look at? Can equities continue this bull run?
Yeah, I mean, at the end of the day, you need to look at the growth environment. Yeah. We're definitely not in a recession, at least for the kind of next 6 to 12 months. And if you rule out the risk of a recession, equities tend to do quite well, right, in these environments. However, as I mentioned at the beginning, it's probably not a straight line up, right? You would have like some of these pullbacks, 5%, 10% pullbacks, as we're witnessing, for example, in China markets today, right? You have expectations of policies. The policies actually would take time to come out, therefore the market kind of pull back. So I think for investors, I mean, these are actually not bad environments because you would get pullbacks to add on to positions or to kind of sectors or names that you like. Right. So, I mean, I think, over the medium term, we're still quite positive, but just kind of there would be kind of these market pullbacks.
So add on weakness, but add what on weakness? What's your advice? Because you just mentioned there, add names that investors like. What are names investors should be liking?
So I think I think in the U.S., for example, the cyclical sectors are where kind of we like. You see kind of consumer discretionary names kind of breaking out. Financials are doing quite well. Industrials are doing well. Indeed, if you look at a kind of one of the sectors that we over allocated to our investors this year is the defense sector. Defense sector has actually been the best performing thematic this year. I think because number one,
like defense military or defense defensive?
Defense military.
Okay.
And I think of course like there is increasing conflicts in the Middle East, but of course but also if you look at kind of the composition of this sector, a lot of that is actually industrials. And industrials actually benefit from a cyclical upturn. So I think some of these sectors are still at very, very reasonable valuation. Even if you look within the tech sector, you're seeing semiconductors kind of coming back up again because that's also more cyclical. In China, we mentioned about Chinese consumer discretionary names, and some of the the financials are beneficiaries of policies. So I think these are sectors that are kind of would outperform in the next 12 months or so.
Stephanie, thank you. Stephanie Leung there, Chief Investment Officer at StashAway, kicking off the week with us. And you take a look at this presser that's happening in China. We don't have the live pictures, but it doesn't look like it's too interesting right now, I'll tell you that. But we are seeing when it comes to equity markets, though, a bit more whipsaw. There you go, where you are seeing onshore markets now losing ground. This was more about steps to support businesses from some of these regulators as part of this briefing. So they talked about vowing to speed up the refund for illegal charges the government has imposed on businesses, to promote the use of reputation as a basis for financing. Nothing too earth-shattering as of late right now. But there you go. HS Tech is down some 4%, Dave.
Yeah, for more color on what's going on right now, CLI, we go for our Bloomberg clients on your terminal, commentary analysis, and also the latest headlines coming through from this ongoing briefing taking place, of course, in mainland China. Plenty more ahead. This is Bloomberg. Welcome back. Here are some of the stories that we're following this Monday morning in the Asia Pacific. China and the EU have failed to reach an agreement here on the bloc's planned EV tariffs. It's after 8 rounds of negotiations. Now, China's Commerce Ministry says that significant disagreements remain, and it wants the EU to send a technical team as soon as possible for further talks. The EU voted earlier this month to boost tariffs to as high as 45%. Now, China has threatened its own tariffs on European dairy, brandy, pork, and also cars. Now, Chinese EV maker BYD is working on its strategy to woo European buyers. The vice president of the company, executive vice president Stella Li, told the newspaper that the company may initially offer EVs in Germany for about $27,000 to $32,000. Now, the plan comes after the EU this month voted to impose tariffs of as much as 45% on EVs.
And we're watching those EVs this morning as well. There was a bit of what China mentioned about major disagreements when it comes to those EU EV tariffs. This is Bloomberg. $11:29 a.m. in Tokyo. Japanese markets are shut here this morning, so we're focusing on that reopen in Hong Kong as well, where we are continuing to see extended declines when it comes to what the H-share market is doing. It seems like A is winning in some ways, but then again, we are seeing things lose a bit of momentum. We talk about turnover. I think we're talking about 500 billion RMB of turnover, which is basically, I think, less than half of what we've been seeing the past week or so. So certainly we are seeing maybe that disappointment seep in a little bit. But Asia ex Japan is looking like this here right now. We're slightly down. U.S. futures are also slightly down this morning, Dave.
Yeah, well, things couldn't have gone up in a vertical line. You know, we front-loaded a ton of turnover and price action in the initial 2 weeks or so. So I guess that's good to let it simmer a little bit right now. And as I guess I'm pointing out, right, so we wait for pullbacks here. We are expecting to see a further weakness and consolidation in many of these markets while we wait for more information on whether the economy does respond, of course, to everything that's been mentioned so far. Just a recap of what some of our guests have been saying about Saturday's finance ministry briefing. Have a look.
It is clear that they are just tackling some of the structural issues. They are not really looking to massively inject, so it does not constitute a whatever it takes moment, in my opinion.
Yeah, I think what we've heard is a positive longer term. Short term, I think maybe see some downside here.
In terms of direction, he was very, very on spot. However, he was not upfront in terms of the amount of the new issuance of central government debt. For that, he needs the NPC, National People's Congress, to support him.
And I think to have a swap of the local government debt that will ease the accounts receivable pressure in that whole ecosystem, which has been worsening based on the financial data. So I think structurally it looks fine. Short term, it is not as satisfying.
For more context on these market moves this Monday morning, our Asia equities reporter Charlotte Yang is here with us on set to talk us through. So prices are down, turnover is coming down a little bit compared to last week. What does that tell you?
Yeah, I think this morning is a lot of volatility. And so far, I think to us, it shows that market hasn't really reached a consensus in terms of how much fiscal will Chinese government has to support the economy. So basically, you have two camps of investors. One that is more, slightly more positive, looking at the positive tone from the Ministry of Finance and the positive guidance saying that, we have room to raise those deficit. But today it looks like the more risk-on traders are gaining the upper hand, looking at the lack of a clear figure going forward. And also, we have a bunch of data coming out later this week. So I think the big actions will still have to wait until later this month from the NPC to figure out to get more details in terms of how much figure we'll see from Chinese government in terms of fiscal support to the economy.
Yeah, is it just about being patient at this point? But what else are you looking out for? You mentioned data this week as well. It could be key.
Yeah, so we have a lot of economic data coming out. We do have the retail sales and also some from the GDP figures as well as the fixed investment data. And so I think a lot of and also we do have more briefings coming out from the government, including today as well. So I think for now, a lot of investors are choosing just to stand on the sidelines and see, especially for the longer term investors, and to have a better gauge of where we're going in terms of the policy directions.
All right. Charlotte Ping and Charlotte Yang there, Bloomberg Asia equities reporter, on the latest when it comes to where the Chinese market is going as well. We're taking a look at property stocks in particular here. They were actually rallying at the get-go of this open, and looks like we've reversed most of those gains here this morning. Shimao Property down some 5%. We're keeping an eye, of course, after Beijing promised new measures to support the sector. Let's bring in Bloomberg Intelligence senior analyst Kristi Hung. She's with us now. Yeah, what's your take on this MOF briefing and the support that we heard that could be coming from the property sector?
Yes, I think compared to the central bank, which came out with more forceful steps earlier, and the Politburo comments that showed greater determination to stop the slump for housing market in China, the Ministry of Finance support is underwhelming, or if not, disappointing. A lot of equity investors are expecting, more big bang fiscal stimulus coming for the housing side, and specifically the issues of unfinished homes and also the issues of, the affordable housing push being very slow. These are not addressed sufficiently. We are not seeing quantifiable targets or funding that's being pledged to move things forward.
Okay, so what specifics would someone like yourself be looking to hear, for example? What convinces you further? Would convince you further, to rephrase that?
Yes, so for unfinished homes in China, that's the elephant in the room. We are calculating that, there are 48 million units of unfinished homes that need 11 trillion yuan to complete, at least. And what authorities have pledged so far is barely sufficient, not even 10% of what we think is needed. And I think as long as home buyers are keenly aware of the risks that pre-sold homes in China might not be completed, even if you're introducing more demand-side stimulus measures, you cannot meaningfully boost new home sales in China. So that's one thing. The second thing is affordable home push. So Ministry of Finance talked about local governments issuing special bonds to finance this. This is not new. Bloomberg News has reported in August. And I think for that regard, what we're seeing is specifically for the slow process. For these, we're facing hurdles, including low rental yield for these projects, and rental yields can barely cover funding costs for these projects. And also, there's also a lack of suitable projects. Developers have big units, but local governments want to acquire small units. So these hurdles needs to be fixed in order for us to accelerate the digestion of unsold homes in China to meaningfully restore demand-supply balance.
In terms of the next possible steps for policy, what may that be now?
Yes, so we're still expecting a short-lived home sales recovery that's geared towards T1 cities in China. If things are not planned out as authorities would want, what we're seeing likely would be rate cuts next week to further lower mortgage rates in China. We are also expecting, Beijing and Shanghai have further room to relax home purchase restrictions. And on the other hand, down payment for smaller cities, there's a room for smaller cities to cut first home down payment to 10% to further ramp up the demand-side stimulus to try and shore up confidence in the market.
Tell us about, let's put everything together. Tell us about this webinar that you and your team are planning here.
Yes, so it's tomorrow, 4:30. We will be addressing, the recent China stimulus and what it would mean for property developers and banks. And also, Patrick will be talking about the policy address upcoming for Hong Kong and what that means for Hong Kong developers.
Okay, Christy, thank you so much. Christy Hung there, our Bloomberg Intelligence senior analyst on What to Watch moving forward. Right, a former PBOC advisor has told us China's fiscal policy will help bring the real economy back on track. Earlier on, we were joined on shows by David Daokui Li, says that the main issue will still be the economy's ability to sustain growth beyond this year.
In terms of direction of policy adjustment, the Minister of Finance was absolutely right. That is, the central government needs to rapidly and in a major way increase its debt issuance and as a result to support local governments. In terms of direction, he was very, very on spot. However, he was not upfront in terms of the amount of the new issuance of central government debt. For that, he needs the NPC, National People's Congress, to support him. However, the good news is that in China, we don't have a good or a bad. We don't have a two-party battle in the NPC. Once the central government decides what to do, the NPC will follow up quickly. So I do expect that by the end of this month, there will be a huge increase in the central government debt. And using that, the central government will support the local governments. Local governments getting the cash will pay their delayed payments to their employees, to their contractor workers, and then the macroeconomy, the real sector will be back on track.
So you said there might be room for further stimulus, Daokui. I'm just wondering, are you saying that it's likely then that they're going to repeat what they did last year and basically raising that fiscal deficit target of more than 3%? Or do you think it's a little bit too late in the year to do so now? Doesn't matter actually now if they do it?
Well, for this year, the 5% GDP growth rate is not a big issue because technically this target will be achieved because the 5.0 is real GDP growth. And real GDP growth is actually nominal GDP growth divided by GDP deflator. And deflator is a mystery. Nobody knows actually how high it is, how low it is. So 5.0 technically is not a big issue. There will be in the end that it will be achieved. Okay. However, the real issue is how to make sure the economy will continue growing next year and the year after. And the economy, how can the economy recover from this carbon problem? The carbon problem has major problem in one thing, that is local governments are running out of cash. Local governments have been using short-term debt and loans to finance 20-year, 30-year long-term infrastructure projects. So it is irrational, it is even crazy or draconian for local governments to pay back their debt in the coming 1 or 2 years. This is a self-inflicted wound, okay? So finally, the central government got it right. The central government needs to issue tremendous amount of bond to swap out local government debt. This is more than deficit. This is a capital account management. That is, central government has assets and liabilities. They have to manage this capital account. By the way, the Chinese central government is by far the richest central government in the world, holding shares of the most profitable commercial banks and the 3 most profitable mobile phone operators. There's no reason for the central government not to issue a huge amount of debt to help out local governments and in turn to help out macroeconomy.
Take us into where you think the overall budget deficit should be. So all things included, central government budget deficit, local government spending, how big should that fiscal hole be next year and the year after to get China's economy out of this deflationary spiral?
Well, to give you a very quick answer, I truly believe a 3% deficit, at most 5%, will be more than enough. But my key point is that this is a wrong question. This is a wrong question. We are thinking in a conventional way. We are thinking about the current income and current expenditure of the central government, and that we call the gap is deficit or surplus. What we are needing, what the central government needs to do is to manage the asset part, the asset liability account of the central government. The central government of China holds lots of assets in stock market listed companies, such as the 6 most profitable commercial banks. Meanwhile, the central government holds very little, only 25% at most of GDP in terms of debt. So there's a tremendous amount of net equity for the central government. What central government should do is to issue more liability, issue more debt, and use the money to swap out, to buy local government assets in the form of infrastructure projects. So this is a capital account management. This is in the sense of in the company, paraphrasing the company's language. This is a merger and acquisition, M&A operation. This is not spending your capital expenditure. This is not about the current account. This is about asset management. So I truly believe we economists have to really restudy public finance. We need to have a new mentality, a new framework to explain this to the policymakers and to the business people, to the general public.
That was David Daokui Li, there, Tsinghua University Director and former PBOC advisor, speaking to us a bit earlier in the show. Still ahead, Taiwan's government tells Bloomberg TSMC is planning more European factories with a focus on AI. We're here exclusively from the tech minister, Wu Cheng-wen, next.
The world's biggest chip maker, TSMC, could be looking at further expanding its facilities in Europe. That's according to Taiwan's tech minister. Although TSMC has told us it has no new investment plans currently. Our tech reporter, Annabelle Jewellers, joins us now to talk us through this. So, Belle, what else did we hear in that exclusive interview of yours?
Yeah, we certainly got a lot of colour from Minister Wu, about TSMC and its outlook plans. Of course, TSMC, you mentioned being the world's biggest chip maker, you would expect the government to be in very close communication with them about helping them to maintain that competitive edge. We know that TSMC has already broken ground on a new facility in Dresden in Germany. That's to produce chips mainly for the automotive sector, so the automotive sector chips are not the most advanced ones. Taiwan has kept the most high-tech components still on the island. Of course, it faces a lot of pressure to push that elsewhere around the world as well. For his part, Minister Wu has indicated that TSMC perhaps has further expansion plans in Europe. TSMC, we spoke to about that as well, saying that they've still got their current investment plans in place. They don't have any further ones at this stage, but still, here's what Minister Wu told us. And remember, of course, he is someone who has very close communication with that company.
I don't worry about whether the Republic or the Democratic parties. That I believe they will all agree on continuing the same direction. I don't worry too much about that.
Do you see that putting further pressure then on Taiwanese companies to expand production facilities in the US?
Well, it's an issue. I believe, yes. But in short term, maybe it's painful for the Taiwanese companies because it's more expensive, actually, if they move over there. But in the long run, maybe it's good for them, from my point of view, because they can improve themselves.
I do want to talk about the other areas for cooperation between the US and Taiwan, and drones has been highlighted as a particular area.
Drones, yes.
Where would you look to partner?
We are working on a model that maybe we can establish a local supply chain here in Taiwan, from chips to other components and to the modules to system. And we would like to work with the US based on the innovative systems that have been developed in the US, because in the past we don't have this kind of industry.
China has really established a lead in the drone market for a variety of different uses.
Right, we know that.
How long is it going to take for Taiwan to catch up, and can it catch up, do you think?
That is why we are working on this project now. We don't want to use drones from China anymore in the future. Our intention is to gradually replace all the components from China. And as a matter of fact, most of the components may be made by Taiwanese companies in China today, but in the future, we would like to invite them to come home.
Returning to semiconductors for a moment, but speaking about China, people will talk about the technological advancements that China is making in its chip technology. Others would say, actually, you need to think about how far is China behind TSMC, and that really gives you the true indication.
When we talk about the most advanced technology, I think China is behind quite a lot. But if we're talking about mature technologies, they are not behind.
How many years then are we talking about?
When we talk about the most advanced manufacturing technologies, which is 2-nanometer silicon technology, CMOS technology, I openly say that more than 10 years.
You mean it takes a full decade to catch up, or you think that it can be done sooner?
Not any sooner. Impossible.
So Minister Wu, they're just offering some insights into the relationship between the US and Taiwan, in particular, this new cooperation we're seeing in terms of drone technology. That is a space that is really being dominated by China. And also on that sort of tech competition between the US, Taiwan and China, and the delay that China has in catching up on the most advanced technology. But certainly it puts that US election into even greater focus, because Taiwan really does rely on the US as a security partner in this, and certainly is going to be watching the outcome of that election very, very closely, Yvonne.
Belle, great interview there. Our tech reporter, Annabelle Jewelers, bringing that to us from Sydney. We're still staying on Taiwan, and China's military is holding drills around the island that it says are a warning to Taiwan's government to halt what it calls separatist acts. Now, a spokesman says the exercise involves Army, Navy, Air, and Rocket forces. Taiwan's defense ministry says that it dispatched forces to respond. Taiwan's President Lai Ching-te said last week that he would stand up to the challenges posed by China.
Yeah, and just on this story, just within the last hour or so, the U.S. military has put out, a State Department specifically, has put out a statement, very short one, 3-paragraph, to effectively call on the PRC to act with restraints and to avoid any further actions that might undermine peace and stability in the region, that they are also continuing to have a closer look at some of these activities around that part of the world. So that's the latest as far as that's concerned.
And remaining still that long-standing commitment to that one China policy as well. So nothing too new in this statement, but certainly we did get a response from D.C. We got plenty more ahead. This is Bloomberg. All right, here's what's trending in China. Look at some of the headlines in national newspapers this morning. And the front page of the People's Daily says China will strive to achieve its economic goal for this year. In an editorial, the paper says the fundamentals of the economy and favorable conditions, including economic resilience, have not changed. Now, the article says that as long as China has confidence and implements precise policies, its economic development will continue. And meanwhile, the Securities Times sees the Chinese Financial Ministry briefing on Saturday, boosting investors' confidence in domestic and capital markets. They spoke with analysts who say the briefing did buoy market confidence, with some seeing the bull market for China continuing.
Yeah, and what we probably are seeing right now is maybe just this period of consolidation in that bull market that, as some of the bulls would put out, of course, an opportunity to add more exposure to some of the names that might have raced too quickly ahead of some of your liking. Right now, MSCI China we're near session lows, 1.5% to the downside here. Most, of course, of these constituents are here in Hong Kong, where markets are reopening after a long weekend. The brokers are in focus here for various reasons, one of which, of course, is turnover picking up. It's coming back down a little bit, relatively speaking. There's also the big story out of CICC and it being investigated by the securities regulator. And separately, Hai Tong and Guo Taijunan, of course, were limit up past tense in China earlier on that merger. Very quickly, Anta Sports down as much as almost 9% in Hong Kong City. Out with a note talking about how one of the company's brands here missing estimates, amplifying the sportwear maker's structural downturn.
Yep, Fila is that what they're talking about there. That's it for us here on the China Show. Bloomberg Markets Asia is next.